options. Really, we're just trying to break these down, peel back the layers, and find out what is making these options pricing move in different directions at any given time. At the end of it, I think that you guys, when you finally turn on those options montages, you guys will be able to understand what you're seeing. It's not going to be intimidating at all. So with this video, what I like to say is give you a little bit of color as what we will end up talking about, and that is going to be the short put butterfly in this webinar. But before all of that even happens, what I like to do is build ourselves up to that, because the last thing we ever do is decide on what type of option strategy. Now, it's not so easy when we're doing these videos here. I need to have some kind of content, right? We have to have some kind of direction. So when we end up talking about the short put butterfly. But before any of that happens, we have to have a lot of things sorted out before we come up with the type of strategy we're going to have. All right. So without further ado, let's get on with this. But again, let's start out with some simple concepts to try and wrap our brains around this whole options trading thesis. All right. So we've got data transfer right here. We've all talked about this before if you've watched this any of these videos in the past. But what we're talking about is this is the fastest, the most streamlined way to transfer data over the internet. And all it is a series of O's and ones, zeros and ones. And that's what makes it so simple. But if we pause it and freeze frame this, peel back the layers of this onion, then we can see that all it is O's and ones in different order, right? And then there's actually different layers. Those are different data streams going. Well, that's similar to what we're going to be looking at in the option montage. Each one of these layers is a different expiration, a different meaning. And we're going to talk about all of those. So at the end of it, when you turn to this page, it will almost look like it's frozen in time, and you will be able to really decipher what's happening at any given moment during trading. All right. But when we're trading, we're always talking about value and what something's worth, right? What's the best investment somebody can make? Mark or Frank, you got something? He's saying hello. Jump in here. Guys, comment away, because you guys drive the content here. As a matter of fact, you guys will drive the direction of this video with your comments and questions. So please don't hesitate to throw something over there in that comment box. Don't forget to smash that like button too, if you will. But what's the best investment one could make? Generally speaking, what is the first thing that comes to mind? Well, for me, every time I'm talking to somebody, it always seems like they're talking about housing, right? They're always saying that everybody needs to go and purchase a house. And this all started way back from, I guess even Mark Twain said this, but the person that really sticks out in my mind was Rockefeller. And when asked what the best investment one could make, he said it's in dirt. And what he meant by that is land. If you could go out and buy as much land today as you could, it surely is going to be worth something more tomorrow. Why? It goes back to supply and demand. And if you guys are watching the daily market videos, you guys hear me talking about supply and demand all the time with pricing. But supply and demand, we are on a globe, right? They aren't making any more of this globe right now. Yeah, you could fly off to the moon maybe and get some land up there, but that's not really inhabitable right now. So, or habitable right now. So what we're talking about is this finite amount of land. The space on there is limited. So we have a limited supply of land. And the more and more people that are populating this little globe, well, they're taking up more space. They are wanting to buy that space from whoever owns it. And that value continues to go up because of the supply and demand matrix, right? But what have we seen happen? I mean, if it's a house, what has happened to housing prices in the past couple of years? Trying to learn as much as I can about butterflies. Well, one thing to know about butterflies is they don't always follow all of the rules. You got to think about butterflies as they start out as a caterpillar and morph into something else. So when I talk about rules and we're talking about how to trade options, some of these things get a little wanky with the butterflies. Just know that getting into it. All right. And I'll explain all that. Don't run away. Don't think I'm going to shut this down too soon. But at the end of the day, there's some little quirks about it that we need to talk through. All right. So housing prices, and what I mean by lately, I don't mean by the last week or so, but last, let's say 20 years coming into, say, the 2000s or into the aughts, as we used to call them, which rolled over into 2000. But markets were moving pretty nicely going into the 2000. We had the dot-com crash, right? Housing markets took a little bit of a dip. Anytime we see the markets really take a tumble, what do people do? Well, they sell houses, they try and raise capital. So we do see markets take a little bit of dip there. 2000. So then we got a nice big rally going after 2000, that dot-com crash. Everybody was very comfortable for about 10 years. And then what happened in 2009, we had the financial crisis. Now those prices really dropped. So if you had bought right before the financial crisis, that wasn't a very good investment. So while one says over the course of a long period of time, we have a tendency to see those prices rise, the fact of the matter is timing is everything, right? If you had bought right before the dot-com crash, as a lot of people did, they were buying way above what they could afford for the most part, and that was exacerbating this downside, but it did nonetheless take a major dip. Now, we have recovered quite nicely since then, but right during COVID, 2 years ago, we saw housing prices dip again as people were really fearful of what was going to happen. Now, some places did see that spike. As a matter of fact, here in Arizona, where we got a massive influx of people moving here to Arizona, housing prices took a very short dip before they rallied. I know of a place up in Cave Creek where they started dipping quite quickly as the pandemic started ramping up. But somebody I know scooped one of those houses for about $1 million under. So I think they paid, it was like close to 700,000, six something, at a 6 handle on it, and sold it for 1.6. So those prices we've seen go almost parabolic since the pandemic, as there's this urban sprawl and folks are trying to get out of the inner cities. That's making the suburbs or places like Arizona really shoot straight, almost feeling like parabolic at some points there. So we've had a nice big rebound, but what are we talking about now? Interest rates all of a sudden rising. We just saw Great Britain move their interest rates 50 basis points today, first time in 11 years. So interest rates are on the rise globally now, not just here in the United States. We've been hearing that quite a bit here lately. But what happens to when we see interest rates rise? It's basically they raise interest rates to make savers out of us so that we park money in the bank and don't go out there and spend it, because when we're spending money, we happen to create inflation there. So if they can temper that a little bit by increasing interest rates to get us to start saving a little bit, well, that should slow down the spending. But another thing that happens, and we talk about this a lot in the daily market commentaries, is the teeter-totter effect that we see with interest rates, right? If interest rates are going up, the price of those bonds are going down in relation to that, right? That's one of the things we talk about. Another thing is when you're buying a bond or you need to buy a mortgage, well, you're really getting a bond with that. As interest rates rise, and we talk about this when interest rates are at zero. Okay, let's back up. Let me back up. I'm getting a little ahead of myself. So when we're talking about interest rates and buying a house or buying a car, that interest rate basically at zero. When we're buying a house, we have to buy a mortgage or we have to take a loan out for that. Well, then that mortgage payment every month, all right, part of the money goes to the principal, part of that money goes to the interest rate, all right? So as interest rates rise, the bank is getting more of that payment every month, okay? It's still the same payment, but we could see that interest rate rise and more of it's going to the interest rate. And what I mean by that is somebody who got a loan on a $300,000 house, all right? So I'm just going with the national average. It's somewhere right around $300,000. Now, if you bought that with like a 3% interest rate, 3% interest rate was what you were paying to the bank. Now that we're looking at mortgage rates being up around 6%, now 6% mortgage interest rate, if we have a finite budget, all right, and I can only afford what they generally say is 25% of your monthly income should go, or is all you should allocate towards your mortgage. So let's just say, for instance, for math purposes, let's just say that somebody was making $48,000 a year. All right. I'm just trying to make, and he's probably not going to be able to afford a $300,000 house at that point. But if you had a $48,000 a year salary, basically you are making $4,000 a month, right? And if I said that you should only allocate 25%, and listen, I'm not a financial advisor, folks, you need to talk to your financial advisor. This is not advice. This is just, we're rubbing out some numbers here. So $4,000, 25% of that is $1,000 a month to the mortgage. All right. This goes to your mortgage. All right. So if I can afford $1,000 a month to my mortgage, when interest rates are at 2% versus, let's just say 5%, the difference there is 3%, right? 3% interest rate. So when interest rates are really low and I'm paying $1,000 towards my mortgage, a lot more is going to the principal of that than when I'm paying $1,000 over here. Okay. Now I'm not smart enough to do the math right now. As a matter of fact, it's kind of late in the day for all of us, right? And I've been doing math all day. I really am not going to be able to figure out the math on the difference here of that 3%. But my point is, before you could afford a lot bigger house because more money was paying off that mortgage principal. All right. If I have to pay more towards the interest rate, then I can afford less of a principal payment, which means smaller house. So what happens when we see interest rates rising and people can't afford those more expensive houses is that housing prices start to dip from that. Okay. So while I don't think that we're going to see a massive market crash, the fact of the matter is somebody who bought right before we started seeing interest rates rise could in fact have bought near the high. Okay. Because the market is starting to dip. So while it's a very novel concept to buy land and sell it for higher, we know, or buy a house and sell it for higher, buy low and sell high, seems so simple and easy. It's all about that timing and knowing if price is expensive or if price is cheap, right? We don't always know going forward what's going to happen, but looking in the back half, we could see that buying up here right now feels expensive, but if the market took a parabolic move again, we wouldn't feel that way. So it's very difficult, and it causes a lot of bad trading practices when folks don't understand the levers and pulleys of pricing. Okay. So, and I'm not talking about valuations and understanding what the valuation of Apple is. I could care less, to be honest. My whole thing is just, is it going to go up or down? And if I don't know, I have strategies for that too. And I use those often. If I think it's going to, as a matter of fact, it's today. Is it a pop or a drop? Like, I don't know if it's going to go up or down. And sometimes we're at that point, right? I can't think of a word to say. I'm drawing all kinds of blanks today. My head is like flying way ahead. So sometimes we just get this feeling like, hey, this underlying is either going to go higher for this reason, or if that doesn't work out, it's going to drop. One could say that about Twitter right now, right? If Elon Musk is forced to take over Twitter, it could go higher. If he doesn't, it's probably going to go lower. All right. So those are things where you could come up with your assumption. You actually might have the completely opposite assumption. If Elon takes over Twitter, then it's going to tank. And if he doesn't, it's actually going to rebound. I don't know. At the end of the day, we can come up with our assumptions, and they could be very different. That's the beautiful thing about trading in the markets. The thing that you need to know, though, is when you're trading options according to these guidelines, and what we find with cracking the code to trading options is that you can at least turn the tables of probability in your favor when you're trying to decide what type of strategy you're doing. As a matter of fact, I've been talking about the IBM trade in the daily market commentaries. That trade has been directionally against me But the way that I set up this strategy, it's actually working out. So I'm not too worried about it. All right. So those are things that we try to teach you folks that, hey, when we're trading options, the beauty in this is we don't always have to be directionally right to make that money. All right. So this one, we have to have a big move. We want that big move to happen right away. So a little bit more about when we're talking about trying to find pricing and whether or not prices are expensive or cheap, we have to look at charts, or generally speaking, we look at charts. Yes, you guys could go through, and a lot of you guys might be able to be, or are probably financial advisors or financial aficionados. But when we're talking about stocks, what happens with those is they get their earnings. And then what a lot of analysts will do is they will look out and say, all right, well, they did better than what we expected. They are doing very well. They consistently do better. So 5 years down the road, I think that they're going to have their sales as a multiple of today. Sometimes it's, five-time multiples. Sometimes it's like 20, 30 times. I think Costco is like a 30-time multiple. All right. So they put those multiples on it. What happens when the economy slows down? They roll back those multiples. They don't say anything necessarily about their sales right now, but they roll back some of those multiples. So if Costco went from a 30 multiple to a 20 multiple and their sales continue to rise, well, that would make you believe that the stock price should go down because they are on a multiple of today's trades. Another thing we do, so when we're trying to do this with charting, we try and draw like support and resistances in there. So when they come to those supports, that's where we look to buy, and they hit those resistances, that's where we look to sell. Bullish and bearish markets do very similar, where the markets are ebbing and flowing, and we try to draw in our support and resistances in there. All right. The thing with bullish and bearish markets, trying to find those support and resistances takes a little bit of a keener eye. When we're looking at things that are lined up horizontally, our eye has a tendency to put that into levels and kind of can really see those a little bit easier, just like we see faces in certain things. Despite the fact that I might not be drawing a face, people might immediately look at that. I could be saying those are targets, but it sure looks like a face. But that's because our brains are wired that way. We see faces in toast or in salt things under viaducts. So our eyes are drawn to lining things up horizontally and seeing faces. It's that easy. So it takes a little bit more of a trained eye to get the bullish and bearish support and resistances, but it's really not that heavy of a lift. Sideways markets, though, tendency is to be able to see that very good. But again, we never really know, even if we're looking at the charts, we could see that this is, a sell zone, right? Because that's where it's had resistance in the past. But how strong are you that this is going to continue up to that line? We don't know, right? It's really easy when we've seen what's happened in the past, but we get to this point and it seems to be a little bit more difficult for us to pull that trigger. Well, I hope to be able to make that a little bit easier for you, because we're going to be able to show, while stocks and looking at a stock chart is still very difficult. You got to be kidding me. Oh, you guys, I've been drawing and everything. You guys want to see? I got a little carried away. All right, folks, you know what we're going to do? We're going to back up a little bit here, because I'm going to try and erase some of this stuff. I'm going to have to time out here. 20 minutes in, and you guys reminded me. You guys are slacking. I have a tendency to get a little carried away and start talking and chatting and not showing my screen. So here, let me get back to some of this real quick. So let's get back to this one here. This is the chart that I was looking at. So going back to this chart, this is where I was talking about. What do we have a tendency to do when we're looking at toast? We see, if I'm just drawing something, what happens? All of a sudden, if I just said, okay, here's two dots on a chart, what does that all of a sudden do to you? What's everybody seeing right now? You guys could throw it over there in the, feel free to chat. I'm trying to keep an eye over there. There's a couple of people, Ron and Mike were blowing me up saying, hey, show your screen, bro. You're not doing it. So you see a face, right? I mean, am I the only one that sees a face in that little stop sign? Just because I drew 2 dots there, that makes it a face? It's because our eyes are wired to see faces in crowds or in toast or patterns on the wall or something like that. Or clouds, you always see faces, right? Or at least heads or bodies and things like that. It's because our minds are wired that way. Just like it's easier to line up horizontally some different charts than it is on bullish or bearish ones. On bullish ones, sometimes it's harder to see where those support and resistances are for some folks. Bearish markets could be, like this. Sure, support and resistance. I like to get mine a little bit tighter. You guys are probably, better at drawing in lines than me even. But when we're looking at this, the idea is to buy low, right? Buy down here, buy low, and sell high. When you see it on the chart like that, that's all you got to do, folks. Buy low, sell high, right? Except for you buy low, sell high, you come down, you're thinking, okay, look, I got a nice rebound. It's going to take off to the moon, right? That's just basically some weak hands covering, and you buy now, thinking you're going to get a rebound, and then it drops. Because remember, we don't know what's happening out there, right? What if you sold down here? That's completely opposite. You're buying high and selling low. And that happens a lot because we get panicked out. Like, oh my God, why did I get back into this thing? And then you dump it out, and sure enough, it could be the rebound. So while it is a novel idea to buy low and sell high, it isn't as easy in practice because, like I said, we're out here. We don't see what's happening next. It's easy to go back in hindsight and say, oh my God, yeah, it's so easy. You should have done this. And you see people do this when they're selling their platforms or whatever. They're like, look at all these winners. Okay. Well, I've traded on those platforms before, and they don't always call it out. Or if you miss it by a second, you're done. So anyway, buying low, selling high seems like a novel idea. It's so simple. It's stupid. It is too simple and kind of stupid. But options do give us a tell as to when they are cheap or expensive, because volatility is a sideways trending market. You will be able to spot this rather easily, these support and resistances with volatility. And I'm not talking the VIX, you guys. VIX does give us a broader overall gauge as to what the economy or what the market is feeling in regards to volatility, because it is counting all the buys of the calls and the puts and stuff like that. And as more people buy, that's usually a sign that there's fear in the market, and they're either buying calls because they're FOMO, their fear of missing out, or puts because they're fear of the downside. They're hedging their portfolio, or they're buying puts around their Apples or their Googles that they own, right? So they're buying those puts because they're worried about downside. Now, when they do that, and because they are in panic mode, they're buying without regard to price. Okay, they're buying just saying, I need to save myself money and buy these puts. When in fact, they probably have already missed it. If they started to panic, everybody else is already put on their positions. You're behind the curve. So while volatility looks like this, I'm looking at implied volatility. All right, implied volatility is what we want. And there are places where implied volatility shows up all over every trading platform, okay? But it's not often talked about as implied volatility. In the option montage page, it's called Vega, all right? We have charts, though, that we follow that are implied volatility, and they look just like this because they're sideways trending. When we have an underlying, it doesn't matter. Apple has its own implied volatility coefficient, meaning it has a range that it likes to stay within, all right? And that might be from like 20 to 40, And then something like Tesla might be something like 60 to 100. So we couldn't compare Apple's implied volatility to Tesla's to see if it's high or low because they're completely different beasts. All right. We need to look at Tesla's implied volatility against Tesla's implied volatility. We look at that in the past to see what is going to happen going forward, or the expectation of going forward. And with that, I've had a lot of folks recently reaching out to me and talking about, well, they don't have implied volatility charts and stuff like that. You can use historical volatility, but I would encourage you, if you have the opportunity, to use implied volatility. It's just a little bit better metric, because implied volatility, what it does is it doesn't care about what's happened in the past. Implied volatility is forward looking. All right. So implied volatility is saying, I expect volatility to be here going forward. All right. So it's not based on anything that's happened in the past. But with implied volatility, we know with these underlyings that they stay within a range. So although it says, hey, I'm going up to 40 because that's where I see we're going. Well, that's probably it's close to the highs of what this range has been. Whereas historical volatility says, all right, well, this was high before, and now I'm higher than that. So, now it's really high. Okay. Because I thought it was high before, and now it's high. It's even higher. So it gets a little wanky that way, but truly it is a pretty good judge of the ebbs and flows of that volatility of that underlying. But I would encourage you guys to stick with looking at implied volatility. It's just a better metric. Like I said, it's not basing its number because it's looking forward. All right. Historical volatility is basing this number in accordance to what it's seen in the past. Okay. So we want to make sure that the data is not getting twisted from what's happened in the past, especially because we just had that thing called Corona. And a couple of years ago, it made volatility really spike, which is a black swan event. But historical volatility doesn't look at black swan events as, hey, I need to discount that. It says, hey, it's there. So I need to pay attention. To me, that black swan event, I want to kind of take that out of the data point for what I'm trying to use volatility for. I'm not going to completely forget about it because it is, in fact, a possibility, right? But it's just a very unlikely possibility. So I don't want to try and wait for that for the next 10 years to happen. All right. So implied volatility looks like this. Again, like with charts, we're just going to try and draw a support and resistance in there. And the reason why we do this is because all of the Greeks, when we get over there to the options page and start really talking about trades, we're going to get in there and start looking at these Greeks. Okay. Yes, I said it. We're going to talk about the Greeks. And as a matter of fact, by the end of this, you guys are going to know the Greeks better than probably 80% of the people out there. Because I've got some really easy ways to remember these, some floor trader hacks. All right. Like Vega is just volatility, right? The V in the Vega, volatility. But all of the Greeks are based on an advancement, meaning they are going to increase or move forward. So like delta is based on the underlying moving higher. All right. Theta is based on time passing. Vega is based on volatility increasing 1%. All right. So 1 percentage point is what Vega does. And then all of those options, if volatility increases, implied volatility increases by 1 percentage point, meaning this goes from, let's just say this number is 21 and it increases to 22. That's 1 percentage point. All of the option pricing will increase. All of it will increase. I don't care where it is. Calls, puts, in the money, out of the money, near duration, further duration. They're all going to increase. They're not going to increase the same. They're going to increase according to each coefficient, right? Meaning 100 call, that volatility coefficient's the one I got to look at, the 100 call, not the 80 call. All right. We have to look at that one's implied volatility coefficient or Vega coefficient. So if it increases by 1, all of the options increase. Now, no, further duration options will increase more than the near duration options. And the reason why that is, anybody know? Throw it over there in the chat window. Anybody know why volatility affects further duration options more so than the near duration options? That's right. It's because we don't know what's going to happen way down the road, right? 250 days out, I have no idea what's going to happen. 2 days out, I probably have a pretty good idea, right? We're getting this data right now. We can see what the markets are doing. So I know what that is. But further out, I don't know what's going to happen. So volatility affects those further duration options more because it's more unknown. The near duration options, well, we kind of know what's going to happen there. So it doesn't really affect those as much. Volatility affects the further duration options more. All right. But back to what I was talking about. Some stocks will have, or almost all stocks will have their line in the sand where they stay in a pretty good range there, just like this. So while volatility looks like this, we can take advantage of this chart to understand our pricing for the options. Now, I don't care what the stock is, all right? I'm only looking at the stock as, hey, I think Apple's going to do better, it's going to go higher. Or, hey, I think Apple's going to do worse, it's going to go lower. Same thing with IBM or any other stock I do, right? I'm not thinking about the multiples. I'm not thinking about their pricing and what their value is. I'm thinking about their directional move, right? So that is going to influence my decision as to up or down more so than anything else. But once I've come up with that directional assumption, whether it's up, down, or sideways, then I need to come up with a strategy, right? If it's bullish, what do? Well, you don't know. You could buy calls. You could sell puts. Those both give you money if you're directionally right. But if I had a bullish directional assumption, high volatility, I would not want to be buying calls because that would be buying high, right? I already told you, if volatility is high, you don't want to be buying anything. You want to be a good steward of your capital. You want to sell at that point. So when volatility in these underlines, we can chart them. We can draw support and resistances, and then I like to try and draw a 50-50 line there, and this is a sell zone. This is your buy zone, right? Because when volatility is down here, we know that the options are the cheapest we've seen in just about the last year, right? Some of the cheapest we've seen. So that is the opportunity to buy options. So you come up with your directional assumption, whatever it is, and then you look at this volatility chart and you see it's really low. Well, you know you're going to be buying an option strategy. Except for, I'm trying to learn about the butterflies. Well, except for with this strategy because of some of the levers and pulleys of combining two strategies, because that's really what's happened with the butterfly, okay? But 99% of the time, when we're not talking about butterflies, if volatility is extremely high, you want to collect a credit, and when it's extremely low, you want to be paying a debit or using a debit spread. So again, here is a chart, or a volatility. It doesn't matter what the underlying is. I don't even care what the price of this underlying is. So we'll just call it ABC. And what we want to do is kind of look in the past. I like to try and draw these lines in so that I get a couple of clips on it. All right. I don't mind it piercing through a little bit for me, especially on volatility, because I'm just trying to catch it when it's at extremes. Okay. It could go a little bit more, but I don't care if it goes a couple of percentage points against me. I want to take advantage of the massive moves, like the 10-point moves, okay, with volatility. You know, like something like if I had gotten involved in here, yeah, I might have taken a little heat on it, but look at this massive drop and looks like it's getting ready to plummet back down to these support levels, right? So again, we can draw in these support levels there and say my dotted line kind of in there. This is your sell zone. This is your buy zone, okay? Just remember butterflies are a little bit different because they morph. Right. Here I've drawn in the lines. Okay. So we put these in there, 1 year chart. We can see that it stayed within these lines. And a lot of you guys might be out there saying, dude, you're off your rocker. Have you seen what's been going on lately since the pandemic? Volatility's through the roof. A lot of you folks might be talking about the VIX, right? VIX historically is generally somewhere in the teens, but right now we're in the 20s. Here's a chart of the VIX. Usually, historically, believe it or not, you get up into the 20s, and that's pretty high. Yeah, we have seen high volatility as of recently. But what I can do with these underlines is still draw in these support and resistance based on what we're seeing currently, extend those lines to the left, and then drop out a longer chart. And what happens? You'll see this happen a lot, even now after the pandemic. Here's the pandemic spike. I want to discount that in my data points going forward. I don't want to forget about it, because if we see that kind of unknown happen again, guys, this is probably the point where this underline, I don't know what it is anymore. I don't remember what it is because it doesn't matter, but let's just say it's XYZ on this one. This is XYZ. It doesn't matter. We know that XYZ, when it gets up to this level, which we'll call around 45, is pretty high. And down here, we'll call this 25, and that's pretty low. Right there, just right now, right in the middle, like very middle of the road. We have strategies for that. As a matter of fact, today's strategy is a pretty good one for somewhere between, this gray area in here. I don't want it super low. I don't want it super high. I want it a little bit off of the middle there. Just a little bit off the low, but not quite high. And yes, we are collecting a credit. Generally speaking, when I say you're doing something as a short, you're doing it as credit, you're collecting a credit for this strategy. Yes, this one is the butterfly going to be collecting a credit, but we want it to be in this little zone. I usually call it the 30% implied volatility percent. All right. And we can do the math on that. Basically, you take the high, the low, and the current, and that's where you're trying to draw in your lines. The high and the low being the extremes, current right at 50% on this one. This another one, drawing it back, you can see the ebbs and flows. Yeah, we might think that we're in extreme high volatility right now, but you draw those lines out to the left, and sure enough, they're in line. Not all of them. Some of them, I think I have an example coming up, will have a move incremental higher, okay? And that is with NVIDIA. Some of these other stocks have seen an incremental clip higher. You do have to take that into account. NVIDIA being attached to Bitcoin, that volatility has seeped into that underlying. Again, here, I would just draw in my lines. You can do the math on this too and figure this out. Basically, the math for something like this to find the exact number is the current implied volatility minus the low, and then take that sum and divide it by the high minus the low. Okay. And what that does in a situation like this, you take the current, which is, I'm just going to say it's, this one's a little bit higher. So this one's current is 45. I haven't done the math on this. The low, we'll say, is 20. The high is 50, right? This is somewhere right around 50. The low is 20 still. So we do our math, right? We got 25 divided by 30, and that ends up being, somebody do the math for me. I'm basically in the, is that 90th percentile? I'll have to do the math. My brain is not doing math right now. If somebody's got a calculator, that would help quickly. Can somebody do that math for me? I'm searching for my calculator. All right, here we go. So 25 divided by 30, 83 percentile. All right, so basically this is the 50-50 line, 50% line, right? Try and draw that in there. Again, sell zone, buy zone. Now, when we're doing the math on a butterfly, the sweet spot for a butterfly, sweet spot for a butterfly, there you go, is around 30 percentile. That's kind of the sweet spot I've found. The reason why with a butterfly, it's a combination of two strategies. So they're going to, because when volatility is really high, it's telling you the expectation of a massive move is about to happen, right? So with this strategy, we want a big move to happen, all right? We want it to blow outside the wings. So in order to do that, we have to have a little bit lower volatility. So if volatility does expand, then that will help us out for one. But when volatility is expanding like that, it usually means there's a big move currently happening. So we want that big move to happen. So with this butterfly, the flies are kind of in here on the short flies, right? They're a little bit opposite. And I'll tell you why here. I'll show you why here in a second. Again, drawing lines out to the left, you can still see before pandemic, before we ever knew anything was going to happen, we were still in those same, support and resistance. This is NVIDIA. It is easy to tell because it's gotten that incremental move higher and has pretty much stayed there. So I would be keeping this as my low for NVIDIA for the foreseeable future until it really starts breaking away from anything that Bitcoin does. But the only way that's really going to happen, folks, is if Bitcoin goes away, and NVIDIA would tank. It would go back down to like $50 rather than, I think it's around $200 right now. And again, you can see that when that incremental move higher, this is NVIDIA pre-pandemic, post-pandemic, starts really getting involved with the volatility of Bitcoin, and it's kind of created another paradigm. So I'm going to stick with that paradigm for this one, and would then draw in another 50-50 here, kind of throw that in right there and say, okay, this is your sell zone, for sure sell zone, and your buy zone. Now, if you don't believe in what I'm talking about, I have no problem with that. If you guys say, hey, dude, it's going to go back down there, so that's not a buy, I'm good with that. Just make sure that you guys keep in mind that the underlyings are going to migrate back to the mean of what their volatility is, okay? It doesn't get overextended too often here. So NVIDIA's implied coefficient will remain like this for quite some time. All right, so volatility, if you haven't taken anything away from this, it's the major driver of pricing. We could look way out in time, those further duration options that are being affected by volatility the most, because that's the most unknown. Well, some folks say, hey, those are priced more expensive because they're so far out in time. And that's true. That's very true. Those further duration options are more expensive because you're buying more time to be right. The near duration options are getting ready to go off the board. There's not a whole lot of time to be right. And there's probably not a big move left to happen within that, all right? So those prices have really dwindled quite dramatically the closer and closer to expiration. Like I said, further out in time, we don't know what's going to happen, but near, when it's almost expiration, we got a pretty good idea where this thing is going to land, right? If it's a $100 stock, it's probably not going to land at 200, and it's probably not going to land at 0. It's probably going to land somewhere between 95 and 100 on those last couple of days, right? So volatility drives pricing at any given time, meaning we take a snapshot of those further duration options in XYZ, all right, today, and let's just say they're 250 days out, those further duration options. If I looked at those just on the time decay or the time factor, the theta, though that pricing should be exactly the same, the next time we get the monthlies only having 200. So let's say July, August, Sep. So like November, let's just say January's right now. If January's pricing right now was, let me just look at let's pull up an option montage to explain this a little bit better. Okay. So what I'm talking about, these January, 183 days out, okay? Now, I look at these pricing of these at the money 410 options. Now, if I went 130 days or 183 days and these January options were coming off the board and I went out to the options that had 183 days left, okay? 183 days have gone by. These January options are getting ready to go off the board. And I roll back to the options that have exactly 183 days. If this number was exactly the same volatility, then these numbers would be exactly the same also, because the theta is something that will erode, and we know that from the beginning. It's going to roll out. If the price never changed in this underlying and the volatility never changed, this pricing should be the same, all right, in theory. And it would be very, very, very close. But if this volatility dropped to 20 percentage points came out of this, well, we would see these pricings massively drop. All right. The pricing here would be $20 lower. If this volatility, remember, every 1 percentage point decrease or increase, Vega affects the options pricing. So if this dropped from 45 to 25, 20 percentage points, well, 20 times $1 is about 20 some dollars, right? So $20 would come out of this. Now, if this increased at any given point, the underlying didn't trade a penny higher, a penny lower, time didn't trade, but volatility fluctuated like this, well, we would be watching those prices go like that too. They would be flying back and forth, adjusting at every tick volatility made. So yes, the further options are more expensive, but the thing that is driving the real pricing here is volatility. It's the one that is going to make those prices expensive or cheap, right? Because theta is finite. We know at 130 or 183 days that there is a finite amount of theta in there, or time decay in there, right? Because that time decay has got to all come out. But it will be pretty finite. I come back next January, or next July 21st, July 21st of 2023, and I look at those January contracts and Alta hasn't moved, it should be right around the same price. All right, if everything is the same. So with that said, on this underlying, you can see we could do the same thing, drawing those support and resistances, kind of drawing your line in the sand. Let me see if I can get my pen going here. So your resistance and kind of your support. Now, like I said, I don't mind if it breaks through here. I don't mind if it breaks through here. I want as many opportunities as I can. So I try and get it to kind of clip on a lot of them. I don't mind if you guys go to those extremes. Just know that you're going to have less opportunities, right? Again, I'm going to draw in my 50-50 line. And normally this would be the buy zone, but we're looking at a butterfly and it's right in here. With this underlying, I'm looking at a pop or a drop. I don't know which way it's going to go, but I do have a tendency to see going into earnings that this underlying has big moves heading into those, heading into an earnings. Now, I don't know if it's a whisper trade or whatever, but it started to make a move and I've got quite a bit of time. So it's either going to continue that way or I think it's going to make a big move to the downside heading into that earnings, just because that's kind of what Alta does with its earnings. So I'm going to try and play that. All right. With that said, a pop or a drop, my strategy could be a lot of things. It could be a long straddle. We talked about those in these videos, right? A long straddle, a long strangle. That would be appropriate for a big move to happen. But the problem is with a straddle and a strangle, or a butterfly, a long iron butterfly or a long iron condor, is that we want extreme low, right? We want to pay the cheapest we can for those kind of strategies because they're lower probability. So if it's a lower probability strategy, I don't want to put a lot of money behind it. So if I was going to do that, and we talk about that in these videos, I want it to be at more of an extreme. I want to know I'm getting these things for cheaper. So I still have my theory. It's going to pop or drop. I just need to figure out what's most appropriate now. And we can tell by the pricing, I don't want to be buying options right now. It's kind of middle of the road, if you will. And I don't want to be selling options for sure, because that's way too low to be selling options. Generally speaking, but here we are talking about a butterfly, and the butterfly is going to turn that table. So anytime you get this like gray area where it's kind of really toggling back and forth your 50-50 line, and you've got a little bizarre move directionality wise, butterfly could very well be the best choice for this type of strategy. All right. So let's simplify it real quickly. Before we start getting into the nitty gritty, here's where we're going to get our floor trader hacks. And if you guys have a light bulb moment here, please let me know by smashing that like button. You guys can comment, all that stuff, or type a Y, like I got it, like yes, I got it. All right. So the Greeks, we're going to do this. If I get my pen up. All right, the Greeks. The first one, everyone's heard of this one, right? Delta. All right. Now, delta is just data. All right. It gives you all kinds of data. It's actually some really great data if you're a data hound. And what most people will talk about when we're talking about an underlying, we've been talking about XYZ mostly, right? And to make everything simple, let's just go with $100 stock just to try and make it easy for us to all wrap our heads around this. And when we're talking about delta, and it's a Greek, so it's all based on what? The advancement, right? Moving higher in this case. An advancement is not moving lower. Advancement is moving higher. The assumption with all the Greeks is a move higher or a move forward. So delta is based on $1. So delta is based on $1, the first dollar, if you will, first dollar move. So it'd be when this underlying moves from 100 to 101. All right. And so in the options, we have calls and we have puts, right? And then we'll have like these things that go down the middle. They're like a 95 strike, the 100 strike, a 105 strike, right? Is kind of what those look like as you're rolling it out there. So the ones that are trading, or the options that are right there where the underlying is trading, I should say. So all of these calls that are the 100 calls are the at the monies, meaning they're right there where the underlying is trading. Those are basically a 50-50 delta, because the idea here is that the underlying could move higher or lower at any given time. So as these at the money calls are a 50 delta, let's just say, so this is the delta, the puts are going to be a negative 50 delta. All right. Because it's based on an advancement. If we're moving higher, those puts are really not so sexy. So they're getting a little cheaper. All right. Now, in this case, the 95 strike is in the money for the calls because they're below, right? Remember, options, call options give you the right, but not the obligation to buy the underlying. So calls that are in the money have a benefit, right? Like everybody wants to buy XYZ at 95 when it's trading 100, right? That's really buying low and selling high. Well, options, the way we price them, it's really, you're not getting that much of an edge. And that's due to time decay and probabilities and things like that. But calls that are below the market are in the money. Calls that are below the market, or puts that are below the market, are out of the money, right? Because nobody wants to sell XYZ at 95 when it's trading 100. Why wouldn't you just sell it at 100, right? So puts based on the advancement are negative. Now remember, if the underlying moves down by $1, what does that do to puts delta? Well, a negative plus a negative makes it a positive, right? So as we move down, then that's why that becomes a positive. So delta is based on the first dollar move. So if XYZ moved up by $1, right? Now we're at 101. Well, these calls, let's just say these, I got my delta in there. Let's say these calls are basically, I'm going to just write over this, $2.50 at $3. All right. The delta is still 50 over here. This one I'm going to say is just $2.50 at $3 also, just to make math, because they're right there at the money. And this is still a negative 50 delta. All right. Negative 50 delta. All right. So now we moved higher by $1. We know that delta is based on that first dollar increase. So we moved up by $1. That means delta goes into the calls, right? Because it's positive. So now we would see on this dollar move, these premiums would increase. They would be $3 at $3.50 just on that first dollar move. The puts, on the other hand, would go now to $2 at $2.50, right? Because that first dollar move, this is a negative delta. That delta comes out of our premiums, all right? Now we have gamma. Actually, I'm going to go back to delta in a second, but gamma just goes with delta. All right. And this is dollar number 2. So now when the underlying moves to 102, gamma goes with delta and adds in. And usually those at the money is right around 5. It's a very small number. It's not usually huge like delta is. So gamma goes with delta. So if this is a 5 handle, gamma is going to be positive, goes with delta, which is 50 cents on that second dollar move higher. Now our premiums would look like $3.55 at $4.05, right? Because they've increased now by 50, the delta plus the gamma, 55 cents, right? Does that make sense? Did I lose anybody there? That makes sense. Please type a Y over there. All right. And then gamma goes with delta on that put side as well. But gamma's positive, puts are negative. So now it's 45-cent increase. So 45-cent decrease. So these would now be 155 at 205, right? Because it was 45 cents now. Does that make sense? Gamma goes with delta on dollar number 2. All right. The other thing with delta is it's data. All right. Now back to these at the monies. They're 50 delta, negative 50 delta. The underlying is trading at exactly 100, right? We've got these 100 calls. Why are they a 50-50 delta? Generally speaking, Ron's in the house. He's gonna throw a wrench in the cog in a minute. No, I'm kidding, Ron. What was I saying there? So the delta, because it's a probability of 50-50. It's a 50% probability the next tick is higher or the next tick is lower. So when we're looking at delta, delta tells us the rate of change. And that's what a lot of people will talk about. It's the rate of change. The next thing that I hear somebody talk about with delta, and it's usually wrong, is that they tell you that delta is the probability that you'll see your strike trade. No, it is that your strike will go in the money. And that's not true. Delta is the probability that your strike will finish 1 penny in the money at expiration. So on that day that it expires is what those probabilities are based on. All right. Not today, not tomorrow. It's saying today your probabilities are, 50-50 that this 100 strike will finish 1 penny in the money. All right. I know I said a lot there. A 50 delta tells you the probability that strike will finish in the money by 1 penny. All right. So it's a 50% probability. Out of the money options on the call side, let's talk about a 25 delta. 25 delta tells you that strike So for instance, let's just say this strike out here on the 115s is a 25 delta. That means that that strike has a 25% probability of finishing 1 penny in the money when this option expires. It might be 35 days, 100 days, whatever it is. Okay. But it's a 25% probability, 1 penny in the money. All right. But on the floor, we had this thing that we would say 2 times the delta equals your probability of touch. So a 25 delta, right? 2 times that, 2 times the delta equals 50. So a 25 delta during the life of this option has a 50% probability of trading that strike just one time. Like if I'm talking about this 115 call, it's a 25 delta. During the life of this option, I've got a 50% probability I will see XYZ trade 115 at least one time. And that might be it. You might see a flash up on the screen, the all-time high, and that was it. You had your chance. So what I talk about with options is your probabilities. You know, if you're 25 delta, you don't have a very good probability of being in the money at expiration, but you have a pretty good probability of seeing when your strike trades. So I would pull my trade when I see my strike trade on those out of the monies, especially like a 16 delta for sure. And then the next one we got is your thief. Anybody had a light bulb moment? Thief. The thief is theta. Theta is the thief in the night that comes and steals your premiums. Now, something with theta is it's not very consistent. It actually gets more and more aggressive. It's not binary. It doesn't just happen and it's gone. It's not like linear, meaning it's not like a penny, a penny, a penny, a penny, a penny. It's actually more of a ramp. So I'm going to erase some of this stuff because it's getting a little overdone. I want some of this back. Let me erase that. Don't forget your 2 times the delta probability of touch. All right. So we've got theta, the thief in the night, and we're going to draw this in there. It kind of starts out, he never goes away, but he's not very aggressive. And then all of a sudden he starts picking up and then it drops off. So basically we say some right here is 7 days to expiration. That's where it really goes bonkers. But what we see is right out here, about 35 days to expiration is really when it starts to speed up. This is your sweet spot. All right. And then outside here, it's about 70 days. That's what I look at. So this is kind of your buy zone. All right. I want to buy basically somewhere 70 days or further out to buy. Okay. That would be my buy zone because you can see that the theta is not super aggressive. It's always downward sloping, but it's not as aggressive out there. 35 days to expiration, we really see this drop. As a matter of fact, we will see like a 50% drop in your premiums between 35 days to expiration and 7 days to expiration, right? So if you got in here just from theta should erode about 50% of those premiums just in that next, 28 days or something. All right. So this is where we want to sell our options, right? Sell our options and buy our options. Limit theta decay, be a good steward of your capital, and then get in here and sell high and buy low, right? Because that's where it really starts to ramp up. And inside of 7 days to expiration, he's taking gobs of money out of your pocket. And then, of course, we talked about Vega, and Vega is based on that 1 percentage point move, right? Vega is always positive. Volatility increases, all options increase. Volatility goes down, all of the options are going to drop in price, all right? So now, folks, you guys shouldn't have to worry about the Greeks, right? Let's get on to a real life example just to pound this home, and we'll see that these options that are trading right here around the at the monies, generally speaking, you know, we're kind of right in between here on these two, right? But we can see these are right around a 50 delta on these, negative on the puts all the way across. Now, like I said, gamma is a little bit smaller number. Gamma goes with delta on that second dollar, right? Theta is always negative. I don't know if I mentioned that. This is the calls, by the way, in the put side. So it's pretty easy. Calls are always on the left. Puts are always on the right. And theta, very aggressive compared to out in time. As a matter of fact, I love going through this little process here. Look at 184 days to 150 days, right? That's about 30 days, just 33 days or something. How much did theta increase during that time? Maybe about 3 cents, 2 cents. All right. Well, I guess I got to go 100 days, so that's going to hurt a little bit. It's not going to make that much sense there, but you can see that it increased by about 10 cents over that time. But outside of 70 days is where I'm usually looking for, which is not giving me a strike there right now on this underlying. But when we're talking about the increases in theta out here, 30 days, from 60 days, let's just say 60 days to 30 days, look how much theta is increased here, 5 cents. Versus out here, it was 2 cents. So over double the theta component. But then we go from this 30 days to that's 9 days, so not even 30 days. And look what's happened to theta now. It's almost doubled here, right? So you can see that the closer and closer you get to expiration, that theta is getting crazy, all right? It's really starting to ramp up. And again, Vega is always positive, but note the difference in the time frames. Way out in time, Vega is going to be much more impactful to the pricing change, right? Or to the volatility fluctuations. So those further out ones are really going to get jukey back and forth. All right. Does anybody have any questions before we move on here? Anybody have a light bulb moment with theta as a thief? Easy way to remember that. Theta is your thief. Vega is just volatility. Gamma just goes with delta, right? And delta is just data. All right. So when we're going out here again, like this strike here, this August strike, 425 strike, this says that in Ulta, in the next, 30 days, has a 37% probability of finishing at, 425.01. There's a 20 or 37% probability in the next 30 days, or on the 30th day from now, Ulta will at least be 1 penny in the money. Okay. I'll say that again. This delta is telling us there is a 37% probability that Ulta 30 days from now will be trading 125.01 or better. Okay. At least 125.01 or better. And, because the markets are always assumed to go higher, theta's a negative, delta's a negative, right? Because it's always assumed the market's going to move higher. So a negative probability. If the market starts going, it's still the same probabilities. You really still have like a 40, 50% probability of being 1 penny in the money at expiration. It's negative. Well, it's because markets always go up, I guess. No, it's a theta. It's a negative based on the assumption of an advancement. But if we started going down in price, then a negative plus a negative equals a positive to our position, right? A negative down move plus a negative delta equals a positive to our position. 1 hour in, no butterflies. I know, Mark. Well, we're getting there, buddy. All right. Boom. Look at that. You speak and you shall receive. I got you, bro. All right. So the butterfly. The best thing to do here is with the butterfly. I like to go with these at the monies for the butterfly. It's a 50-50 probability we're going to go up or down. That's what I don't know which direction we're going. If I believe I have a solid directional assumption or a target I think this underlying is going to go to, then I would not be using the butterfly. The butterfly is really great for indecision. I really don't know if it's going to go up or down. And I want to take advantage of something happening here. So we're going to basically go to the at the monies, those ones that are close to 50-50. Those are the ones that are closest to trading where this underlying is trading. I'm going to buy 2 of those. I'm going to buy those twice. And what I'm going to do then from there is go about 10% width. All right. Or really the easiest thing to do is go to the 90 delta. That's really as close as you're going to get for the most part on this. And then work yourself in if you can. So with this said, let's just get up the platform because I want to walk through this one. Because this one kind of worked out a couple of different ways. I'm going to close this down. We're going to go inside. Generally speaking, we want high volatility. But like I said, with this strategy, we don't want the expectation of a big move to have happened already. We want to get on this before it does happen. So when I'm coming in here on this underlying, we're trading right around 410 was the last trade is what I'm going to go off of. So those are the at the monies. So the first thing I would do is come in here and I'm going to buy 2 of those, right? Hold down the control button. I got on 2 of those. It's 20, but I'll fix it in a minute. Now I'm going to go 10% down, which is basically $40. That's going to take me down to the 70s, right? So the 70s are the ones where I'm going to sell, define that risk. To the upside, 40 to the upside, that's going to give me the 50s, right? So I'm going to sell the 50. That's a little bit tight there on the 10% one. And going down 10%, I'm going to be looking at those 70s, right? And sell those. Now, the big key here is I've got $40 wide. Let me get my pen. I've got to get a different pen. But by the way, Mike, did you learn something about pricing, though, during this whole time with no butterflies? I hope you at least learned something. All right. So with this said, we've got this brought up on the 10%. I like to just go straight to the 90 delta, somewhere in there, and pick that, the 90 and the 10s. But we're going to start out the way I would normally build it out. Go about 10% wide. But I have to be able to, with this strategy, risk 1 to make 1. All right. Meaning my collection of credit needs to be about 50% the width. Right here, what do we have? We have $40 wide and a $16 credit. That's not great. All right. I'd want it to be right around $20, right? That's what it should be. So with that said, then I know it doesn't work. I'm going to have to go a little bit wider with this. That's what you have to end up doing, is defining it a little bit wider. What happens when you go a little bit wider, though? You're increasing your risk, but you're also increasing your reward, folks. So when we're putting all these on here, is it not going to let me drive now? There we go. All right. So try it again. I'm going to go straight to the 90 delta, or as close to it as I can, which is real close to where we were looking at 110s. I'm going to go to the 90 delta here, sell those. Oh, I forgot. I got to buy those 2. Sorry, buy those 2, sell the 90 delta-ish. Let's go to the 60s. So now I'm $50 higher, got to go $50 lower, which is to the 60s again, and sell those. So I've got, did I do that right? 40 to 50, 50. Yeah, we're good, right? So I got to buy an extra one in there. That's why my pricing's off. Okay, so I'm trying to get this as close to as a 50-50 as I can. It's not always going to work, but it's pretty darn close, right? If I go over to the Analyze tab, I'll be able to see that I'm risking 1 to making 1. And then I'm going to show you a couple other things with this strategy as to why we don't necessarily want the thing to be, I want to analyze you. Analyze. So I've got my old one up there, 23. Oh, look, last night it was working out much better. So risking one to make one, $23. I'm going to lose a little bit more on this one by about $1.50. Okay. But perfect world, this should be right 25. That's where I would want it to be in a perfect world. So let's just make it there. Risk one to make one. But what I want to talk about here with this strategy is the way that it works. Okay. So when I'm on this market right here, that pin doesn't work. Let's try this one. So when we're trading right here, this is where we are right now. So if we stayed right here at 110, we would lose the maximum amount because theta would grind it away and the in the money options would be crummy. But what we have is we're long two puts, right? A put here and a put here, both at that 110 strike. And then I'm short strikes at the 460, which is basically right there, 460. Actually, it's probably right. Yeah, that is a 460 strike. And then to the downside for 360, which is right around there. So 360, I should put it on the line there. I don't know why it's over, but oh, I do have it over too far. Sorry. I'm kind of going blind, I guess. Let me fix my line there. Eraser. Oh, it's because it's this erasers. Yes, doing a great job. There we go. Got two markers going today. All right. So here's the 460s. I was trying to look at this and line that up. That's about right. All right. So what happens is we are short puts here and short puts here, right? And this is obviously going down. So this has a long put spread, right? I'm long a put here and short a put. That's a long put spread. So if this goes that way, the long put spread, which is the 410, 360 put spread, right? Which is a long put spread. I'm long this put spread. And then with the defined risk, right? So if the underlying goes down, this one makes the money, all right? And if the underlying blows off to the upside, this one is a short put spread. I'm short 460 puts, right? And I'm long the 360 puts. So this put spread is the short put spread, which is bullish. Because what makes money here is these 460s, when the market moves higher, those puts that were in the money, because remember, puts that are higher than the market is the opportunity to sell at that level. And everybody wants to sell it higher than where it's trading. But these premiums are worth the most out of all of this strategy. So if that goes to zero and I sold that, well, then this strategy does very well. All right. So a big move in either direction. The long put spread will make you the money, will increase in value. You're going to lose money on the short put spread, but the long put spread will make up for that. And the vice versa going the other way. So let's build this out and show you on the chart, or actually on this thing. That go away. What happened? Get rid of that. All right. Let's go back to this chart. So for instance, let's go back to this because some people might look at it a little differently. So this, right? I bought a put and then I sold that put. That is your long put spread. I pay a debit for it. I'm paying $12. So if this underlying falls out of bed and goes down to that 360 level, this long put spread is the one that is going to make me the money, right? It's going to increase in value. These long puts are going to really increase in value. These short puts are going to increase in value, but not as much. And once it gets down to that 360 area, this will be worth $50 because the width of the spread is worth $50. I paid $12. It's worth $58. I make that difference, which is $38. Okay. Yes. But you have to keep in mind that I also sold a put spread up here for a credit. This one would be losing some money. All right. So while the other one's gaining in value, this one's losing in value as well. All right. So they'll counteract each other a little bit. At the end of the day, though, we know we're risking one to make one. We know exactly how much we can get out here. So this one would lose money. On the flip side, if the underlying took off to the upside, right, this 48 right here would end up, these 460 puts, would end up being worth zero. So with these 410s, but all of that credit would go in my pocket, right? Yes, I would lose money then on the short put spread. That $12 would go to zero as well. So $25, right? That $12.30 minus the that $12.30 minus the long put spread, $35. That puts you right around $20-some there, right? So they're offsetting a little bit, but you know it's defined risk strategy. And when you get into the next trade, you can see that it's risk one to make one. The underlying takes off to the upside. Then my short put spread, which is a bullish spread, right? Short put spread. You sell puts because you want the opportunity to buy the underlying, right? So if I'm selling those puts in the money, I don't want to buy it up there. But if I sell those puts for a lot of money and they go out of the money, they expire worthless. That's the big trade to the upside. To the downside, you make your money on these long puts. If it goes that way, these long puts are what's going to be making you the money. Okay. Then a lot of people ask me, would you leg out of this spread? On this one, I wouldn't, because it really is a package deal. If it's blasted off all the way to the upside, well, it would have to be a massive move to the upside. I might take that off. It's really going to be dependent. The problem is I just don't want this market to like juke and jive while I'm trying to leg out of it. I mean, when we were on the floor, we used to leg out of spreads all the time. But now, this day and age, very difficult to leg in and out of spreads profitably. Now, with the iron condor, the iron butterfly, yes, I would say you could do that. This one, you could as well. I wouldn't necessarily recommend it because I wouldn't want to ride this strategy out long enough for that to need to happen. As a matter of fact, with this strategy, I'm looking at this underlying $26. I tell folks, when we're trading butterflies, because they take a very long time to work themselves out. David or Daniel, I see your question there. Give me a second. It takes a very long time for you to ever get that full credit. As a matter of fact, it would be the very last day, and you would be worried about exercise and all that stuff. I would get out of this trade well before that. As a matter of fact, I say 25 to 30% of max profit is what I'm looking to take as a trade here, which means 25% of that 25 here is $5. So if this underlying, if I could get out for $20-ish, let's just say $20.50, somewhere right around there, that's where I would be looking to cover my trade. I would get out around something like that. Okay. So you get like a juke to one way or the other. It went down to $20. I'm getting out for 25 to 30% of my max profit. Low probability strategy. I'm going to be willing to take a little bit less than full credit on this type of trade. All right. And that's my rules. If you guys have the patience of a saint, then, you know, I'm all about you guys, holding on to that trade and squeezing a little bit more out of it. But for me, I like to get in and out of trades. If they're working out, I like to cover them. If I've beaten the probabilities, especially if it's gone up there and touched one of my short strikes there, I'm going to be pulling the ripcord on this trade all day long. So if I see 465 or any of those, like the 465s, one of my strikes, my short strike touch trade, I'm going to pull the ripcord on it. Probably be better than 25, 30% of max profit at that point. But that would be definitely something I would get. All right. So that's all I've got for you guys, other than I'm going to get back to Daniel's question here in a second. I would probably not leg out unless it, was like just a parabolic move and blew through my short strike. I would cover that trade, maybe leave, cover the winning part of the trade. The one that was the long put spread, that's probably worthless also. I might just leave that one on because it's not hurting me anymore. Or it's not hurting me a lot. Probably will hurt you a little bit, not a lot, if you think it's going to rebound. But otherwise, you would have to have the assumption I got this pop or drop. Now I got the pop. Okay, I got the pop. Now I'm going to cover the pop, and I'm going to wait for the drop. Right? I don't know if I'd play it that way. I'd probably just pull the ripcord on all of it. I appreciate you, Daniel. All right, so Ron, I got you. Just give me a second. Does this work very well over earnings? It could, but if you'd have to get that pop or drop. Like it would have worked with IBM. Like that one had a massive drop on. So it can work, but just make sure that you're doing that with earnings that have relatively low implied volatility, because the volatility could come out or it could spike on you. This strategy does a good job of isolating some of that volatility fluctuation, but it's still going to affect the further or those at the money is a little bit more, I should say. All right, guys, here is your offer I'm giving you guys. We're going to open this up. We're 6 months in, so we're going to open it up to a few more people. The folks that joined early are starting to get the hang of it. They're not asking me as many questions, so I'm going to give it off to you guys to take advantage of this. You guys have access to me, full access. You guys can ask me any question, comments, or anything pretty much day or night. I think it says on our website that I'll do it during the daytime or during office hours. But folks, I know how it is. If you guys are feeling the pain of option or trading and you want an answer right now, I'm there for you. I'm going to try and get it to you. So take advantage of that link over there in the side window. Don't forget to like, comment, and hit that subscribe button. And next to it is a bell. The bell will let you know when I come in unannounced. These videos we do pretty much spot on. My spot the trades, though, those aren't so spot on. Those are basically giving up or ebbing and flowing at any given time. All right. Daniel loves trading. So make sure you take advantage of this offer here. Option Lab, take advantage of me. You can reach out to us 310-598-6677. Also, guys, don't forget to hit that subscribe button because, like I said, those morning market videos, I just kind of pull the trigger when I jump in. We kind of set them up for around 6 or 7 in the morning, 6 or 7 Western time, basically 9 o'clock Eastern. But I usually come on just a little bit early, especially if I see some economic data coming out. We got the morning numbers coming out. I usually try and come on right after those, give you guys an idea of what I'm feeling right then and there on those numbers. So if you want to take advantage of that, that's the bell next to the subscribe button. All right. So Daniel's saying he's got, I have BBY on vertical options, $16 and $17 options. So you're talking about BBY. Let's go over that. I'll try and figure out what strikes you're talking about. So first thing I would do is go over here to the charts. All right, so BBY volatility. I would probably draw the line in here and probably in here almost. Well, maybe no. I'd go right there. So let's get lines here. So I'm going to say this is low. And then I'm going to say that last spike is a little too high. So I'm going to go with this double top one there as my high. So that kind of went through there. Middle of the line, I'd say that's kind of middle of the road, right? Eyeballing it. Just, close enough for government work. And draw those lines in there. So again, I would look at this as your sell zone. This is your buy zone. This would be a good place for a butterfly. You don't know if it's going to, I don't know what your directional assumption is here. But What do you have on the? It's for January 2023. Oh, so you're way out in time. So you bought some long duration options. So you got out here in these and bought some 16, 17 calls. Is that what I'm hearing? I'm good with that. Those are about the deltas that I would talk about buying options in my classes. Are you watching my other videos? That's kind of the sweet spot I like to go in for buying options. Now, I don't usually go that far out. I would, kind of stick in here, but I'm more of a short-term trader. If you have a long-term objective with this one, then yeah, those calls will be all right. And you probably bought them at pretty good levels, but still, before you ever buy or sell options, I would look at this. Here I would say buying calls or buying puts in this type of market. Yeah, it's right there at that 50-50. But the thing that I would be expecting, I guess I forgot I had my other platform up. Thing I would be expecting here is volatility maybe to rise. I would have to have that expectation before I decided I was buying on it. What's that? Did I lose you guys? All right. So if I thought volatility was going to creep higher, then that would be the only time I would be buying options right around here. Normally, when it's right around that 50-50, for me, I am looking for something that is going to neutralize fluctuations and volatility. And that's what this one does, right? I've got a short put spread, which should only be implemented in high volatility, right? Because it's a short put spread. And then I combined it with a long put spread, which should only be implemented with low volatility. So it's kind of a middle of the road. You jam those two together and you're kind of isolating that volatility fluctuation. So with that said, that's why the butterfly is a little bit different in this. I want to collect a credit, but I want to do it when volatility is relatively wide, because if volatility is up here at these levels, then that means that butterfly that I was looking at, the 410, and then I defined it with the 360s and the 460s, right? I would be looking at that same one with this type of volatility being, holy crud, way higher. I mean, I might be looking at the 410s as the one that I'm buying and then selling maybe the 300s and then buying the 510s or something. All right. So, or 520s or something to make that equal distance. That's where I would be able to define it to get that 50-50. All right. So that expectation of that kind of move is pretty hard to sustain. So usually when you expect the big move to happen, you don't want everybody else to expect the big move to happen, because usually when everybody's thinking it, that's when it doesn't happen for you. So you have to be a bit of a contrarian when you're trading, and don't be afraid. Like when everybody else is screaming and scared to death, we used to say when there's blood in the water, that's the time to go fishing, because that's when people aren't thinking smartly. They're thinking panic. They're thinking with their pocketbook. All right. And that's another thing. If there's nothing I can teach other than, you guys haven't heard me talking about like dollars and stuff like that. If you're thinking about how much money you're going to make, like I got to make $500 on this trade. Well, you're entering that trade wrong. You're getting involved in that trade with an emotional attachment, right? And when we trade with emotion, we trade like shit, you guys. We trade like we're panicked because we're thinking about this money. That's $500. Am I going to be able to buy groceries, or am I not going to be able to, and all of these things that we conjure up that we need and associate money to start influencing the way that we trade. We cannot do that. All right. That was one of the first things that I learned on the floor. The whale in our pit. Actually, he was he notionally carried the largest position on the floor. Notional value, meaning the size of a contract. You guys remember like bonds, Fed fund futures. That is a $5 million face value contract. And this dude was slinging 1,000 lots. All right. And one tick on a 25 lot was $1,000. All right. Fed funds are moving at 25% point increments with the Fed moving at 75. That's 75 basis points. All right. So a one lot on that 75 basis points is $3,000. And this dude was slinging 1,000 lots. All right. So we're talking some big moves in his account on any given day. I got a little side myself. Where were we? I got a little long tooth there. What were you talking about? Was this on your trade? I would have to have volatility expected to move. Oh, emotional trade. So that's what he said. He came up to me and he was like, "How you doing today?" And I was like, "Hey, I'm up $500." I think it was like, I was like up $600 some odd dollars, and it was enough to pay for a snowboard. I was like, "I'm up $600. I'm going to go buy a snowboard." And he was like, "Dude, you are never going to make it." He was like, "That's horrible." And I was like, "Dude, what do you mean? I'm up." And I was like, "Dude, I know I'm not slinging 1,000 lots and I'm not as big as you, but dude, I'm doing pretty good. Like, I'm nailing this stuff." And he was like, "No, that's not what I'm talking about." He was like, "If you go into this thinking about, I've got to make this much money, or I'm going to look to make this much money today or tomorrow or the next," he's like, "it's never going to happen, because you're going to get there and you're thinking, okay, now I got to double it. I'm doing really good today. I got to double. I got to get to $1,000. And he was like, so that emotional attachment will start making you think crazy. And you don't want to do that, folks. You want to think about this as probabilities. Delta, the probability, my strike. If it goes up, you can look at this. All right. So we're talking about this trade here, and Daniel's talking about his 16 delta, right? It's got a 37% probability, or his 16 calls. It's got a 37% probability in the next 180 days to trade there, right? Yeah, it does. But that's to finish, or to trade there. To finish in the money is a far less, or it's got a 60% probability of trading that price, a 37% probability of being in the money. So if I were Daniel and I saw 16's trade, or whatever the strike was, I don't see it anymore. If I saw that strike trade, that's when I pull the ripcord. I know I've gotten the most out of that trade. Yeah, it could continue to go higher, but I'm out. I'm retooling, dying. I'm moving on to the next one. Right? I don't know how you picture strikes, but it could have been based on, Fibonacci's or whatever. And that also comes into account. Make sure you're playing the probabilities. Take that emotion out. You're picking levels, whatever it is, you're picking levels, you're picking targets, you're picking directional assumptions, you're using that. Stop thinking about it as money. If there's nothing you really take home today, besides that volatility is driving prices, take the emotion out of trading. Think about it as levels, as probabilities, as, I'm getting out at this level. I'm going to get out when my strategy increases by 50%. I'm going to get out when my strategy decreases by so odd percent. All right. And then that will take out, you're not thinking about as money and how much I've had allocated and how much I have to risk here. And am I going to be able to buy groceries tomorrow if I do this? All right. The last thing you want to be doing is having those thoughts go through your mind when you're trading, right? If you're trading according to my rules and the way that I'm doing it, I firmly believe that you will take the emotion out of trading and you will start thinking about it logically, and you will not be as emotional. It goes below that level. You're just like, I'm out. All right. That one I lost on. All right. The probabilities beat me. Okay. So that's all I've got on that soapbox. Appreciate it. Thank you, Daniel. I should have you on. I'm going to have to pay for your YouTube membership or something. Love all the kind words. Thank you guys very much. I appreciate it. Like I said, this is your offer. Take advantage of that. If you're newer to trading options, like I said, you'll have unfettered access to me and all my videos. We'll be giving you guys heads up to some content that we don't necessarily publish. And I think it'll really help you guys out. If you need a mentor, give me a ring. And if you don't, if you can't take that, take it easy. Bye now. Cheers. Appreciate all the kind words. Thank you, guys. There was a book called The Unemotional Investor. Great book. Hey, I don't know who wrote it, but I would totally agree with that person. Thank you, Daniel. But there you go. The Unemotional Investor. It's true. seriously, folks, that is one of the first things I learned on the floor. Bit of a slap in the face by one of the biggest traders on the floor, but it was something I never forgot. And you know what? That might be what's kept me around all these years. All right. So one more time, if you can't take that, take it easy. Thanks, guys. Appreciate you all.